Let's talk about something that sounds a bit like a puzzle: accounting for an organization that isn't actually designed to make money. I mean, how do you even measure success when there's no profit at the end of the day? Well, let's dive in and figure it out.
And that's really the big question, isn't it? For any normal business, accounting is all about profit and loss. It's the whole game. But for a charity, or maybe a local sports club, or a foundation, the goal is totally different. So, what are their financial statements even trying to tell us?
Well, the answer comes down to a really big shift in how you think about it. For a not for profit or an NFP, the goal isn't profitability, it is all about accountability.
Just think about it for a second. If you donate to a charity or you pay your membership dues at a club, you want to know that your money is actually being used for the mission you care about, right? The accounts are there to prove just that, to show everyone involved, all the stakeholders, that their contributions are being managed the right way.
So, how do they actually show this? Well, NFPs usually lean on two main reports. Let's kick things off with a more straightforward one, the one that just tells the basic cash story. It's called the Receipts and Payments account. And honestly, the name pretty much says it all. It's just a straight up summary of every dollar that has physically landed in the bank account and every dollar that has physically gone out. Yup, this is the perfect way to picture it. It's basically a simplified version of a bank statement for a specific period. If cash didn't actually move, you won't see it on this report. It's pure cash in, cash out. Simple as that. And here's a quick look at what that might look like. On one side, you've got your receipts, all the cash coming in from things like member subscriptions or a fundraising event. And on the other side, you've got your payments, cash going out for stuff like rent, salaries, you name it. But here's the catch, and it's a big one. Does this cash-only view really give us the full picture of what happened during the year? I mean, what if the club earned money this year but hasn't gotten paid yet? Or what about a bill for this year that they're not going to pay until next year? That's where this simple report starts to fall a little short. To get that deeper, more accurate look, we need to turn to the second report. This is the one that tells the full story of how the organization actually performed for the year, and it's called the Income and Expenditure Account. So what's the big difference here? Well, unlike that cash report, the income and expenditure account is all about measuring performance. It completely ignores big one-off things like buying a new piece of equipment. It only cares about the day-to-day income and expenses. And, this is the important part, it includes money that is owed to the organization and money that the organization owes to others. And the magic behind this more accurate picture is a core accounting idea called the accrual basis. All this means is that you record income when you've earned it, not when you get the cash, and you record expenses when you've used something, not when you paid the bill. It gives you a much, much truer sense of what actually happened. All right, let's make this real with a classic not-for-profit example that everyone can relate to, trying to figure out the real income from annual membership dues. Okay, so let's say a club gets $580,000 in cash from subscriptions. Now, the simple cash report would just show that number and call it a day. But the income and expenditure account, it's smarter. It would take that cash total and first subtract any money that was paid early for next year. Why? Because you haven't earned it yet. Then it would add any fees that members still owe for this year. So the final number isn't the cash you have in hand. It's the amount of income you were truly entitled to for your work this year. So after all this careful accounting, the income and expenditure account might show a surplus, where income was higher than expenses. But what in the world happens to that profit in a not-for-profit? This brings us to our final and maybe the most important piece of the puzzle. So let's say after all those calculations, the organization ends the year with a surplus, an excess of income over expenditure. Now, in a regular for-profit company, a number like this is the net profit. It belongs to the owners or the shareholders. But remember, we don't have owners or shareholders here. No one's taking this money home as a bonus. So, where does the surplus actually go? It gets added to something called the accumulated fund. This is basically the not-for-profit version of a company's capital or its owner's equity. It's the grand total of every surplus and every deficit the organization has ever had, all rolled into one. And this is such a powerful idea. The accumulated fund isn't just some boring line on a balance sheet. It's the organization's net worth. It's the financial engine, the total sum of resources that it has built up over its entire life, ready to be used to keep its mission going long into the future.
And that brings us full circle, right back to where we started. The entire point of not-for-profit accounting, from tracking every dollar of cash to carefully calculating that accumulated fund, it all comes down to one thing: building trust by being transparent. It was never about profit. It's about proving you're a good steward of people's contributions. So the real question isn't, did they make money? It's, how well are they using their resources to fulfill their promise?